If you've got extra money every month, there's one question that almost everybody asks at some point. Should you use that money to pay off your mortgage early, or should you invest it and try to build more wealth over time? And honestly, this is one of those financial questions that sounds simple on the surface, but once you start doing the math, it gets a lot more interesting, because on one hand, paying off your mortgage early feels amazing. You reduce debt, you save on interest, and you get the peace of mind of knowing your house is getting closer and closer to being fully yours. But on the other hand, investing gives your money the opportunity to grow. And if your investments earn more than your mortgage interest rate costs you, then from a pure numbers perspective, investing could leave you better off in the long run. So which one is actually better? The answer is, it depends on three things: your mortgage rate, your risk tolerance, and your long-term financial goals. Let's break it down. First, think of your mortgage as a guaranteed cost. If your mortgage interest rate is 3%, then every extra dollar you put toward the loan is basically giving you a guaranteed 3% return. Because that's interest you no longer have to pay. That's important, because guaranteed returns are hard to find. If I told you that you could get a completely risk-free 3% return, a lot of people would actually take that, especially in uncertain markets. Now, compare that to investing. Historically, the stock market has returned more than 3% over the long run. Depending on the time period, broad index funds have often averaged somewhere around 7% to 10% annually before inflation adjustments. So if your mortgage is low and your investments perform well over a long time horizon, then mathematically investing may come out ahead. But here's the catch: investing returns are not guaranteed. That's the part people love to ignore. Your mortgage payoff is certain. The stock market is not. Markets go up, markets go down, and if you need that money during a downturn, your plan can fall apart pretty quickly. So if you're trying to make the smartest decision, you need to ask yourself one very practical question. Do you value certainty more, or do you value maximum expected return more? Because those are not always the same thing. Let's say you have a 2.75% fixed mortgage. That's cheap debt. Very cheap. In that situation, a lot of financially disciplined people would rather invest excess cash than rush to pay that loan off early. Why? Because the opportunity cost of paying off such a low interest mortgage is potentially very high. That money could be working harder elsewhere. But now let's change the example. Imagine your mortgage rate is 7%. That's a very different conversation. At 7%, every extra payment toward the principal is like earning a guaranteed 7% return. For a lot of people, that starts looking extremely attractive, especially when market returns are uncertain and taxes can reduce investment gains. So one of the biggest factors in this decision is simply the interest rate on the mortgage itself. Low rate, investing often becomes more appealing. High rate, paying off the mortgage early starts making a lot more sense. Now let's talk about emotions, because personal finance is not just math, it's behavior. Some people sleep better at night knowing they have no debt. They hate monthly obligations. They hate risk. They want simplicity. And for those people, paying off a mortgage early can be life-changing. Not because it gives the best spreadsheet result every single time, but because it creates emotional freedom. And that matters. A financial plan that looks perfect on paper but keeps you stressed, anxious, and second-guessing yourself is probably not the best plan for you. At the same time, some people are comfortable carrying a mortgage because they see it as a manageable tool. They'd rather keep liquidity, invest consistently, and allow time in the market to do the heavy lifting. That approach can also make sense, but only if you're actually disciplined enough to invest the difference. And that's where a lot of people mess this up. They say, I'm not paying extra on my mortgage because I'm going to invest instead. But then they don't invest. They spend the money. And that is the worst outcome of all. If the choice is between paying down debt for sure versus hoping you'll invest later, the guaranteed action is often the safer move. Here's a balanced strategy that works really well for a lot of people. Do both. Instead of putting every extra dollar into one bucket, split it. Maybe 50% goes toward extra mortgage payments and 50% goes into investments. That way you make progress on your debt while still building long-term wealth. This hybrid approach also reduces regret. If the market does great, you're still participating. If the market struggles, you still made guaranteed progress by reducing debt. Another thing to consider is your overall financial foundation. Before paying off a mortgage aggressively, make sure you have an emergency fund, high-interest debt paid off, and retirement investing already in motion. Because it usually doesn't make sense to throw every dollar at a mortgage if you still have credit card debt at 20%, or if you have no emergency savings and one surprise expense could force you into more debt. That's not financial progress. That's just shifting risk around. So what's the smartest answer? If your mortgage rate is low, your emergency fund is solid, and you're comfortable with market risk, investing extra money will often build more wealth over time. If your mortgage rate is high, or if being debt-free gives you peace of mind and stability, then paying off your mortgage early can be the better choice. And if you want the best of both worlds, split the difference. At the end of the day, the right answer isn't always the one with the highest theoretical return. It's the one you can stick with consistently for the next 10, 15, or 20 years. Because wealth is usually not built by one perfect decision. It's built by repeating smart decisions over and over again. So before you ask, which option makes the most money? Ask a better question. Which option helps me stay consistent, sleep well at night, and keep building wealth long term? Because if you can answer that honestly, you'll probably make the right decision. One of the biggest money debates out there is this. If you have extra cash every month, should you pay off your mortgage early or should you invest that money instead? And depending on who you ask, you'll hear two completely different answers. One person will tell you, pay off your house as fast as possible. Debt is dangerous. Another person will say, never rush to pay off low-interest debt when that money could be invested. And the truth is, both sides have a point. So in this video, let's go beyond the emotional opinions and talk about how to actually make this decision like a financial adult. Here's the first principle. A mortgage is not always bad debt. That surprises a lot of people because the word debt automatically sounds negative. But a mortgage is different from consumer debt. It's usually lower interest tied to an asset and spread over a long period of time. That doesn't mean it's harmless. It just means it should be evaluated differently from credit cards or personal loans. Now, when you pay extra toward your mortgage, you're reducing principal. That means less interest over time and a faster payoff date. In other words, you're buying certainty. That's the key word, certainty. If your mortgage rate is 4%, then every extra dollar you pay gives you a guaranteed 4% benefit by avoiding future interest. No volatility, no guessing, no waiting to see what happens. That's a very clean return. But investing is different. Investing is about probability, not certainty. Historically, long-term diversified investing has been one of the best ways to build wealth. Over many decades, markets have generally rewarded patience. So if your mortgage rate is lower than what you reasonably expect to earn from investments, investing may be the higher wealth-building option. Notice what I said, reasonably expect. Not hope, not dream, not assume because someone on the internet said the market always goes up. Expected return is not guaranteed return. And this is where risk enters the conversation. If you're 25 years old investing for retirement and you won't touch the money for 30 years, then market fluctuations may not matter much. You have time on your side. But if you're 55, close to retirement, and that money needs to be more accessible or stable, your decision could be very different. Time horizon matters. Let's use a simple framework. If your mortgage rate is very low, like 2.5% to 4%, investing often has the advantage over the long term. If your mortgage rate is moderate, maybe around 5% to 6%, the choice gets more personal and depends more on risk tolerance. If your mortgage rate is high, around 6.5% to 8% or more, paying down the mortgage starts to look increasingly attractive because the guaranteed savings become harder to beat safely. But there's another factor most people forget, liquidity. When you invest money, it generally remains accessible. You can sell investments if needed. There may be taxes or market losses, but the money is still within reach. When you put money into your mortgage, that cash becomes home equity. And home equity is not easily spendable unless you sell the house, refinance, or borrow against it. That means paying off your mortgage early can make you richer on paper while making you less flexible in real life. And flexibility matters. Especially if you run a business, work in a volatile industry, or just want a stronger cash position. So if you're someone who values access to your money, investing may give you more optionality than aggressively paying down your mortgage. Now let's talk behavior, because once again, math is only half the story. A lot of people overestimate how disciplined they really are. They say they're going to invest the difference, but instead, lifestyle inflation takes over. Better vacations, nicer car, more subscriptions, more eating out, the money disappears, and 5 years later, they have the same mortgage balance and no meaningful investments to show for it. If that sounds like you, then paying extra toward the mortgage might actually be the better move, not because it's mathematically superior, but because it forces progress. Forced progress is underrated. Sometimes the best financial strategy is the one that protects you from your own bad habits. On the flip side, if you're already maxing retirement accounts, investing monthly, keeping an emergency fund, and staying consistent regardless of market conditions, then you may be exactly the type of person who benefits from investing instead of prepaying a low-interest mortgage. So what should you do? Here's a smart order of operations. First, build an emergency fund. Second, pay off high-interest debt. Third, capture employer retirement match if you have one. Fourth, evaluate your mortgage rate versus realistic expected investment returns. And fifth, choose the strategy that fits your psychology, not just your calculator. Because money is not only about maximizing returns, it's also about reducing stress and building a life that feels secure. For some people, the idea of being mortgage-free is priceless. For others, the idea of missing out on years of compounding is painful. Neither person is automatically wrong. In fact, a middle ground strategy often works best. You could invest the majority of your extra cash while sending a smaller extra amount to the mortgage each month. Or you could invest heavily when the market is down and focus more on mortgage payoff when rates are high or retirement gets closer. Financial planning does not have to be all or nothing. And that's the biggest takeaway. You don't need a dramatic answer. You need a sustainable one. If your mortgage is low and you're disciplined, investing will often win over the long term. If your mortgage is expensive or debt makes you uncomfortable, paying it down early can provide a guaranteed and meaningful return. And if you're torn between the two, combine them. Because the goal is not to impress people with the perfect strategy. The goal is to build real wealth, reduce unnecessary stress, and create more freedom over time. And whichever choice helps you do that consistently is probably the right one. Let's settle one of the most common personal finance questions once and for all. If you have extra money, should you pay off your mortgage early or should you invest that money and let it grow? Because this decision can affect your net worth, your monthly cash flow, your peace of mind, and even how quickly you reach financial independence. So if you're trying to make the smartest move possible, here's how to think about it. The first thing to understand is that paying off your mortgage early and investing are both good choices. This is not a situation where one option is responsible and the other one is reckless. Both can work. The challenge is figuring out which one works better for your specific numbers and your specific personality. Let's start with the mortgage side. When you make extra mortgage payments, you reduce principal. That means less interest accumulates over time and you shorten the life of the loan. The result is simple: guaranteed savings. That's what makes early mortgage payoff attractive. The return is known in advance. If your mortgage interest rate is 5%, then paying extra is basically like earning 5% on your money risk-free. That's hard to beat with certainty. Now compare that with investing. Investing offers growth potential but not a promise. Over long periods, diversified stock market investing has historically generated strong returns. That's why so many financial advisors recommend investing instead of aggressively paying off low-interest debt. But there's a reason this is still a debate. The stock market can be unpredictable for years at a time. You might invest during a great decade and do extremely well, or you might invest right before a major downturn and spend years waiting to recover. That doesn't mean investing is bad, it just means it comes with volatility, and your ability to tolerate that volatility matters. Here's a practical way to think about it. If your mortgage rate is lower than the return you expect from investments, investing may be the better long-term decision. If your mortgage rate is higher, then paying it off early becomes more compelling. Simple, right? Well, not quite, because taxes, inflation, and psychology also matter. For example, inflation can actually work in favor of borrowers over time. If you locked in a low fixed mortgage rate, future dollars may be worth less in real terms, which means the debt becomes easier to carry over time. In that case, rushing to pay it off may not be the most efficient use of your cash. Also, if you invest through tax-advantaged accounts, like retirement accounts, your money may grow more efficiently than expected. That can tilt the comparison further toward investing. But again, none of that matters if you can't stay invested consistently. Let me say that again. The best investment strategy in the world is useless if you panic and sell. That's why self-awareness is such an important part of financial planning. If you know that debt bothers you emotionally, if the monthly payment stresses you out, or if owning your home free and clear would give you a real sense of relief, then early payoff may be worth more to you than the spreadsheet says, and there is absolutely nothing wrong with that. Personal finance should support your life, not just your calculator. Now let's flip it. If you're confident in your long-term investing plan, you already have a stable emergency fund, and your mortgage rate is relatively low, then investing extra cash could be the move that builds more wealth over time, especially if you're young. Because when you're younger, compounding has more time to work. Even small amounts invested consistently can grow dramatically over 20 or 30 years. That long runway can make investing far more powerful than shaving a few years off a cheap mortgage. But you need to be honest about one thing. Are you really going to invest the money? Because that's the real test. A lot of people compare paying off mortgage against investing. But what they actually do is compare paying off mortgage against spending money without noticing. And if that's the realistic alternative, paying down the mortgage wins every time. So here's a framework you can use. Step 1, make sure you have an emergency fund. Step 2, eliminate high interest debt first. Step 3, make sure retirement contributions are happening consistently. Step 4, compare your mortgage rate with your expected investment return. Step 5, choose the path that you can follow consistently without second-guessing yourself every few months. And if you still can't decide, use a blended strategy. For example, if you have an extra $1,000 per month, you could put $500 toward the mortgage and invest $500. This gives you emotional progress and long-term growth at the same time. A blended strategy is especially helpful for people who don't want to feel like they're missing out either way. It also helps during uncertain economic periods because you're diversifying your decision-making. Some money goes toward guaranteed savings and some goes toward long-term upside. Now, what would I personally watch most closely? Three things. Number one, the mortgage interest rate. Number two, my investment discipline. Number three, how important financial peace of mind is to me. Because a low interest mortgage with a disciplined investor often points toward investing. A high interest mortgage with a conservative personality often points toward early payoff. And someone in the middle can benefit from doing both. So should you pay off your mortgage early or invest? If your mortgage rate is low, you have a long time horizon, and you can stay disciplined, investing will often create more wealth. If your mortgage rate is high, or if being debt-free gives you confidence and stability, paying off the mortgage early can be a fantastic decision. And if you want balance, split the extra money between the two. The real goal isn't just to be technically correct. The real goal is to build a financial life that is strong, flexible, and sustainable. Because wealth is not just about the highest return. It's about freedom. It's about options. And it's about making sure your money is helping you live better, not worry more. And if you make your decision with that mindset, you'll be ahead of most people already.